Welcome to It's the Economy. The minutes of Reserve Bank's Monetary Policy Committee 8 that a majority of the MPC members believe any policy easing should start only when inflation sustainably moves towards the 4% mark. However, one external member, Jayanth R Varma, told CNBC TV 18 that if GDP growth is calculated from the pre-COVID year, to FY24, it works out to just 4.5% compounded annual. And that, with an inflation forecast of 4.5% for next year, a repo rate now of 6.5% is 2 percentage points of real rate. He thinks it is way too restrictive. That was the dissenting vote. Now, Citibank's economist, Samiran Chakraborty, writing a report a week before the MPC, also argued that urban consumption is actually weakening in India, and hence the Reserve Bank must consider easing its monetary policy to support growth. Today, I have the man himself, Samiran Chakraborty, Chief Economist, Citi, India. Samiran, first, the MPC, what are your key takeaways from the MPC minutes? Do you detect any sign at all of early easing of rates?
I don't think so. I think the majority of the MPC is quite clear on what they're doing. They're very clear that the last mile of disinflation is always very challenging in this kind of a global environment where the markets are kind of running ahead of the policymakers. They're worried that any sign of softening of policy and markets could the yields could fall. The other aspect that they're looking at is that they don't want a situation where they cut rates and then they have to use the MPC's word, backpedal themselves. Another issue is that they want some clarity on whether weather-related shock, they've seen through it, because while core inflation is down, there is pressure on food inflation. So because of these multiple reasons, and most of the MPC members seem to be believing that growth numbers are still quite strong. So there is no urgency in doing the rate cut. So I suspect that because of all these reasons, they will probably want to stay on course to deliver the 4% headline inflation result, see it staying in the system for a while before we can consider rate cuts.
Fair enough. So when are you expecting the first rate cut? Have you changed your mind after the MPC minutes?
After the February policy itself, we had changed our view to some extent. Earlier, we were thinking that maybe an August rate cut preceded by a policy change somewhere in June is possible. Now we think that they get pushed back by one more policy. So the first rate cut probably is not before October. But, this is so far out that a lot of things can change before that. Particularly, we'll have to wait and see whether there is undershooting of growth compared to RBI's expectations, or there is overshooting of inflation compared to our RBI's expectation. It can be in both sides, but depending upon that, that timeline could also shift.
Okay, fair enough. Samiran, now let me come to your very interesting report that you gave a few days back. Why are you arguing that Reserve Bank has to support growth with policy easing measures?
So a basic premise is that historically, we don't see a very good direct correlation between output gap and core inflation. Output gap is simply put the excess GDP growth over the country's potential growth. There could be many reasons for it, but what we find is that if we divide the output gap in what is causing the output gap, whether it is the investment side of the economy or the consumption side of the economy, we find that if output gap is being caused by higher consumption, then core inflation reacts more and substantially more, whereas with investment, sometimes it could be even negative. Higher investments could actually lead to lower core inflation. And within consumption, we find that between the urban consumption indicators versus the rural consumption indicators, it's the urban consumption indicators which have a predominant effect on core inflation. And what we observe over the last 6 odd months is that the urban index, albeit from very elevated levels, is coming off, and the core inflation is following that. Today, the core inflation momentum is at its weakest in the series from the time the series is kind of started. So it's a sense that we get that the demand slowdown is feeding onto core inflation. But I must say that it's difficult to differentiate between how much is due to demand slowdown versus how much is due to commodity prices decline, a lagged effect of that.
No, that is the point, actually. I've heard quite a few experts argue that low core inflation is because of disinflationary trends caused by the Chinese economy. You still think it is India's low core inflation is because of domestic urban consumption slowing?
So, as I say, that it's often difficult to differentiate accurately on this with multiple data issues. In fact, we have to take out housing from the core inflation numbers because housing would always create that distortion in the data with pay commission related impact on housing, etc. So, but if you look at even the services part of core inflation, which is not non-tradable, should not have any impact of input prices, even that is significantly highly correlated with urban consumption rather than anything else. So, and that's also has been weakening. And in the Indian context, it's reverse to what we see globally. Globally, it is the goods inflation which has collapsed, but services inflation has been sticky. In India, services inflation has been lower than goods inflation for a while now. So even that's a very proxy way of looking at trying to differentiate between the global disinflation argument versus the domestic demand argument.
No, actually, if you look at PMI for manufacturing and services, both even in February have come in strong for the last 4 months. What exactly are you finding weakening in urban consumption?
This is a composite indicator that we have, so a lot of things goes into it. But I think the main challenge that is happening is that the urban employment growth at the top end probably is tapering off a bit. And in line with that, the urban wage growth indicator that we have from wage cost of about 3,500 listed companies, that is also coming off. And both these things are turning out to be headwinds. Along with that, the excess savings during the pandemic that the consumers had, that is also now mostly exhausted. So all these factors, along with possibly, this has probably not yet happened, but going forward, and another additional headwind could be any slowdown in consumer credit as well, based out of the current situations. Now, I must also say that while I'm saying it is slowing down, I'm not saying it is collapsing. The growth rate is still in our index marginally ahead of the pre-COVID growth rate, and it's still ahead of the rural consumption. So there is nothing to really worry on that front. It's just that directionally, this is matching with the direction of core inflation.
Oh, okay. Still higher than pre-COVID. That's important. Now, is this slowing urban consumption impinging on your GDP growth forecast? What is your take on GDP growth in FY24, the last 2 quarters, and in FY25? Have you changed it recently?
We are working with about 7% growth in FY24 and 6.5% growth in FY25. So marginally ahead of the government or RBI, marginally lower than the government and RBI forecast. And that's where we have tried to build this in. We will have probably the GDP data very soon for the December quarter. We'll get a sense of whether that data itself is picking up this sort of high frequency data nuances in the December quarter itself. We are working with a 6.7 kind of a number for that quarter, marginally lower than, again, RBI's estimate of 7%.
Got it. Okay, now to come to another point, the US growth is actually surprising on the upside. In that economy, CPI has also been higher, and that is pushing up yields. Will this, US yield impinge on Reserve Bank's thinking of monetary policy, impinge on its action?
First, I guess the Citi's house view is that the US economy will go into recession in the middle of the year. Global growth cost for Citi is only at 2%, and that can feed into the India growth numbers. We have tried to factor that in, and my sense is that even if the main issue would be that if global growth actually surprises on the upside, then some of the headwinds that I was talking of, these headwinds might not be there. I mean, the employment growth situation in India might change substantially if the world economy grows faster. We could have more drivers of growth, and that might mean that RBI pushes back the rate cut expectations even further out. And if we are really unlucky, then the China growth story picks up, leading to more global inflationary pressures. And that could mean that the whole inflation forecast might also have to be looked at. So at this moment, those uncertainties the MPC will have to deal with.
Well, let me put another uncertainty on the table. Can Reserve Bank and MPC find themselves in a peculiar dilemma that core CPI keeps falling, but food CPI remains high, because of erratic monsoon or whatever? Then how will RBI answer this? Will they respond to core CPI or will they refrain?
Well, in a smaller way, the dilemma is already in front of us.
Yes.
Food inflation is running at almost double the pace of core inflation at this point of time. But I guess the way the majority of the MPC is constructing their hypothesis, it appears that the 4% inflation target is very sacrosanct, and partly because of one of the MPC members clearly articulated that it doesn't matter where the inflation is coming from. As long as the inflation is there, it's actually hurting consumption demand. It's hurting the purchasing power of the consumer. So to that extent, we now need to bring that inflation down to that 4% to rekindle consumer demand to some extent. I think that's why the RBI cannot just say that the decline in core inflation is good enough for them to go ahead with rate cuts. At least that's the sense that I get currently.
Yeah. We are flashing Michael Patra's comment, exactly what you're saying, that consumption is actually falling because of high inflation. Therefore, you have to bring inflation under control for growth. Okay, now a final question on bond yields. Indian bond yields, now the Reserve Bank has started giving money via repos, almost 3 lakh crore as of date, and the call rate has started falling towards 6.5%. Now, foreign debt flows have been excellent over the last 6 months. So what is your yield forecast for FY25?
Back a little bit our forecast of when the bond yields will start to come off, because ultimately the markets will have to get the comfort that RBI is okay with easing off some monetary policy stance. And that's where the market will be first looking at the change in stance when it comes. I think that will be the big trigger point for bond yields to start drifting down. Otherwise, let's say hypothetically, we are in a situation where RBI is not considering any stance change or rate cut. Then even if we get these bond index inclusion related flows, we are most likely to neutralize those flows, sterilize those flows through OMO sales, etc., and not let the bond yields drift. But we think that by end of FY25, we'll be heading towards a 6.5 kind of 10-year bond yield. The shorter run, it's more range bound till we get more clarity on when the monetary policy easing actually starts.
Okay. Oh, got that. So the Reserve Bank can play spoil sport, but 6.5 is something. I've heard 6.75, not 6.5. That's a big positive from this conversation. Thank you very much, Samiran Chakraborty, for joining us. With that, we have to wrap up on Bazaar after break. It's time for Chartbust.